The 75% margin reality. Apple just reported a 75% gross margin in its services division, a number that effectively turns their balance sheet into a software monopoly masquerading as a device manufacturer. While the street focuses on the headline earnings beat, the real story is that this margin expansion happened while iPhone unit growth remained completely flat. This is not the result of more App Store downloads or iCloud storage upsells. It is the first tangible evidence that Apple has successfully decoupled its profit engine from the 3-year hardware upgrade cycle. The death of hardware growth. If you look at the P&L, the iPhone business is essentially a utility now. It provides the install base, but it no longer provides the growth. For the last 4 quarters, revenue from hardware has hovered near 0% growth, yet the net income is ballooning because the revenue mix has shifted toward high-margin agentic services. Tim Cook is no longer selling you a piece of glass and aluminum every 24 months. He is selling you a recurring subscription to the proprietary silicon sitting in his data centers. This shift is the only thing keeping the stock at its current multiple as the hardware replacement cycle stretches toward 4 years. This move into back-end compute is where the real leverage is hidden, and it leads directly to the private cloud compute infrastructure. The Agentic Compute Tax. What the narrative calls Apple Intelligence is actually a massive shift in how Apple monetizes your data. In previous years, your phone did the heavy lifting. Now, the heavy agentic workflows, things like automated travel booking or cross-app data synthesis, are routed through private cloud compute. This allows Apple to charge a premium tier for agentic services that functions as a variable compute tax. Unlike the App Store, where Apple takes a cut of someone else's sale, agentic services are pure vertical integration. They own the silicon in the phone, the silicon in the server, and the model running on both. By moving the intelligence off device and into their own cloud, they have created a toll road for every complex action you want your assistant to take. This effectively bypasses the volatility of the retail market and replaces it with a steady, high-margin stream of compute as a service. This skepticism comes when you look at the CapEx required to maintain this lead, which brings us to the hidden cost of those margins. The infrastructure cost problem. The bear case is simple. Maintaining a 75% margin is nearly impossible when your electricity and chip costs are rising. While Apple claims their custom server silicon makes them more efficient than competitors using off-the-shelf parts, their capital expenditure has reached record highs this quarter. They are trading lower operating expenses for massive upfront infrastructure costs. This strategy only works if the agentic services adoption rate stays high. The real implication. The move to 75% margins through agentic services proves that Apple has stopped being a hardware company and has officially become a compute arbitrage business. By leveraging the stalled hardware growth mentioned earlier and forcing complex tasks into their proprietary private cloud compute environment, they have effectively insulated their profits from the slowing smartphone market. For an investor or operator, the takeaway is clear. The iPhone is now just a dongle for the real product, which is the high-margin AI compute layer. This transition transforms the company from a consumer electronics brand into a utility-scale intelligence provider with software-like scalability. If this margin holds, it confirms that Apple has solved the biggest problem in big tech: how to grow profits when everyone already owns your product. The next 30 days will be critical as we see if the consumer response to the new Pro Agent tier justifies the massive CapEx spike. Watch the service's growth rate relative to hardware revenue in the next filing. If that gap widens further, the hardware cycle as we know it is dead. Subscribe for more.